And once you implement these, the processes, and once I was able to do that, I knew that I would cut down on the amount of time on any given day that I needed to spend working on the business.
Welcome to Multifamily Insights. I'm your host, John Casman, and I want to thank you for joining us for another great episode. Listen, if you are enjoying this show, if it's working hard to help you with your investing goals, make sure you let us know that. Leave us a rating and review so we can learn what's working, but also get any feedback to help it work harder for you and what you're trying to accomplish. And if you haven't done so already, maybe this is your first episode, check it out, but make sure you hit that subscribe button so you don't miss any of our future shows. And with that being said, we got a great show today. We're going to be talking to Brandon Jenkins. Now, Brandon Jenkins is a commercial real estate investor, operator, podcaster, and entrepreneur with a passion for adding value to the communities where they own property. Now, he's a syndicator with investing experience, including over 2,300 units as an LP and over 340 units as a general partner. Now, he has a background as an engineer. We're going to learn all about that. Let's welcome to the show, Brandon Jenkins.
Hey, Sean, how you doing? Happy to be here.
Absolutely. Listen, it's great to be here with you today. I went over your bio at a very high level. Take 2 minutes and fill in some of those gaps.
Absolutely, would love to. So I started off professionally, as you mentioned there, as an engineer. So I was specifically as a petroleum engineer, worked in oil and gas for 10 years down in Houston. I live in DC now, but I lived in Houston at the time. And that's also where I got my start as a real estate investor. So as much as I, really enjoyed working as a petroleum engineer, I got to work on drilling rigs. I got to work in roles where I sort of helped to evaluate the assets that the company had. So worked on a variety of projects with incredible people, but also noticed that the oil and gas space, and this I'm sure does not come as a surprise to anyone listening, but the oil and gas space is pretty volatile. Okay, so when the price dips, then there's a reaction in headcount, and there's a reaction in rig count. There's a reaction in activity, and usually that results in people being let go if it's enough of an adjustment in the price. And so during my time in the business, I worked through 3 different downturns. The second of which was a major downturn, and so that really got my wheels turning. Even before then, I was already interested in ways to build wealth, and so I did a lot of research, but I didn't have an answer. But around that second downturn, I kicked it into high gear, reached out to one of my buddies who was an investor in real estate. He flipped properties, but I went out to check out his operation and said, this is incredible, but I wanted to, rent properties out. And so I did a little more research. And then that's how I started into the single family side. And then fast forward to now, I started on the active side as a syndicator, and one of my former coworkers introduced me to it. So really, it started off almost as a need to offset some of the risk, but then it very quickly turned into something that I'm just super passionate about, that I enjoy doing, and I can, I talk about it all the time. So I really enjoy it.
I love it, man. You talked about that background, being a petroleum engineer, doing that in Houston, recognizing the volatility in that market, in that industry, and wanting to branch off into something different. And ultimately you picked real estate. 2 things. When was that second downturn where you really started to pivot? What year was that?
So that was 2014, I believe, is when it first started. That's what, if you're familiar with that industry, that's when the price per barrel went from like $126 or something like that per barrel, and it dipped all the way down to, I believe it got as low as $18 a barrel. So it was an absolute system shock.
Wow.
And
Yeah, that's a huge change in valuations, and understood why that could have the ripple effects that it did. You mentioned that you wanted to get into real estate. You checked out your friend who was flipping houses, ultimately decided you wanted to be into rentals. Just walk us through that process a little bit more. Did you still have your job, or were you let go at that time? And what was it about rentals specifically that you were hoping to gain or invest in?
Yeah, so I still had a job at the time, and it was a very demanding job as well. And I just throw that in there to say that, for a lot of people who are wondering whether you can do this and still work a job, you certainly can. And it depends on which type of, approach you take, whether it's wholesaling or flipping or rentals, right? It does depend on the strategy. But for me, I found that I was able to balance both. So I still had a full-time job. And although I really liked sort of the fast-paced nature of flipping houses, I knew that for me, what I wanted was something to on a repeatable, predictable monthly basis. I wanted something coming in that I had a fairly decent handle on understanding the ebbs and flows of that income stream. And even though I have respect for people who flip houses, it is a bit difficult at times to project and to forecast and understand exactly what's coming in on a regular basis. And also, I wanted something with a higher degree of passivity to it. So I set up systems and processes. I'm all about that. And so for me, building a rental business was much more appropriate and much more of a fit for my personality, because once you set it and once you implement these, the processes, and once I was able to do that, I knew that I would cut down on the amount of time on any given day that I needed to spend working on the business.
I think there are a couple of insights that, our busy professionals can take away. First and foremost, you can invest in real estate while having a day job. It's absolutely possible. The key is figuring out which strategy is right for you. And you talked about flipping houses and enjoying kind of that process, but realizing that it didn't give you really the full value, the full range of benefits you were looking for, kind of the predictability of cash flow, understanding what systems and processes you can put in place and being able to be a little bit more passive. And if you are a busy professional with a demanding job, or maybe you have family demands or other things that you're trying to do with your time, you don't want to have all of your free time going over to a property, checking on contractors, making sure work is done, filing for all your permits and all that kind of stuff, right? So having more of a passive approach, whether it be through your own rental portfolio or investing passively with another group, that's going to be an easier strategy for you to get going. It really just comes down to your own time commitment and your own passions, right? And for you, I guess, as an engineer, knowing kind of what you want to do, looking at those systems and processes, rentals made more sense. Talk to us about the transition from single family rentals to larger multifamily investments.
Certainly. So I got to the point where I had 12 single family properties, and I really enjoyed it. But I noticed that two things. One is I wanted to increase the velocity of my capital, and I recognized that one door per transaction is a slow way to do it. And I also realized that depending on your portfolio size, but if you're on the single family side of the business, you typically, again, one transaction per one door per transaction. But also the vacancy shock is quite a bit different. The vacancy shock and also the expenses can impact you differently. And I say that because if you compare that to multifamily, where you have certain structures that support multiple units, then effectively your costs go down from that perspective, right? So if you have a property and you have a structural issue with the property, then you're going to have to pay a lot more, and in terms of expenses and capex or whatever it is, it only impacts that one unit. And so when you spread that across 10, 20, 50 units, you're effectively decreasing your expenses per door. But for me, that was the main thing: was how can I increase the velocity of my capital? How can I leverage economies of scale and do it in a manner that that really can juice returns and things like that? So my first step was to find apartment deals. I looked for small apartments, 20 to 50 doors. Nothing really fell through for me, but I made a bunch of offers. And one of my coworkers, who's a good friend of mine, he said, "Hey, listen, one of my neighbors is a capital raiser for this thing called syndication deals." So at the time, I didn't know about it. But he and I started to go to meetups in the Houston market, and I really fell in love with it. And so I immediately said, okay, well, I need to do this. So I started to invest into deals as a limited partner, as a passive investor, and just went from there. Never looked back.
Man, I love it. And I love the the journey that you took there, because I think it's really familiar for a lot of people. And some of it may not make sense depending on where you're at in your journey, right? But here, I want to break it down because I think it's really fascinating. You started with your single family rentals and you realized that there was a problem scaling because
Mhm.
of the single families. And were you self-managing or did you have a property manager?
I started off self-managing, and then near the end there, I went to property management.
Okay, so even with the property manager, right, there are still some inefficiencies when it comes to scaling. You have vacancy issues, right? You lose one tenant, now you're 100% vacant on that unit, right? If you have a 100 unit complex, you lose one tenant, that's only 1%. It's not a big deal. So that scale becomes an issue when you have big expenses that kick in. That can wipe out your cash flow for the entire year if you have a furnace go out or have a roof repair or something like that. So those are the things where scale becomes really important. The predictability, being able to project out into the future, all of that is really important there. But you started talking about the velocity of capital, and I want to come back to that point because I think it's an interesting topic there. But realizing you can make more money and kind of increase your cash flow and your velocity of returns by investing in larger apartment buildings as opposed to the single family rentals. You started out looking at 20 to 50 units, but couldn't find a deal that actually, made sense. You didn't win any deals. Put in a lot of offers, couldn't win any deals. And through your conversations with people in your network, particularly a coworker, you learned about syndications, learned about being able to invest passively in these deals. And then you took action to go out and attend these meetups and connect and network with other people, and then finally investing. And the journey that's really interesting is you started investing. So you got to take some action, right? Wherever you're at today, whatever knowledge you have today, you have to take some level of action. Otherwise, this information means nothing. Education without action means nothing. So you started with your single family rentals. Then you look to transition into multifamily. Realize that, you know what, a little harder than I thought to find a deal that works. Let me talk to more people. You expanded your network. You started to connect and network with people at these different events. And that's where you learned about investing passively in these deals. And that journey is important because no matter where you are with your journey, you can stop and look at it and process and say, you know what, man, I'm having a hard time finding deals. What else can I do? You can keep looking, right? You can still be looking for those 20 to 50 units today if you wanted to, right? And keep banging your head against the wall. Or you can stop and say, you know what, I've tried this for a while. I'm not getting the results. Should I change my underwriting? Should I change my return projections? Or should I alter my strategy? I still want to invest in apartments, still believe in that fundamentally, but maybe I don't have to do it all by myself. Maybe there are other groups out there that have the teams, have kind of the resources in place that I can partner with. And I think this is really important for us to stop sometimes, take the feedback that we're getting in the market and actually implement that feedback as opposed to keep trying the same thing over and over and over and not getting the results we are looking for. Did you feel like there was any kind of epiphany when you kind of made that transition and said, you know what, okay, let me actually try to invest with these groups? Or do you say, you know what, this is an absolute last case resort. I'm going to keep looking for this 20 to 50 unit. And if I can't find something, then I'll consider my other options.
You know what? I did have an epiphany, and I love the way you summarize that because, um, for me, what ultimately clicked was, and I think that this is one of the challenges actually in transitioning from the single family game to the multifamily space. What clicked in my mind was, not only should I be seeking out people to help me in this business, but not seeking out the help and going it alone is actually more is detrimental, or it could be detrimental to my success as an investor. um, in the single family space, usually, you can have a pretty decent sized portfolio by yourself. Now you'll still have to have a team of people who support the business, but you don't necessarily have partners. And so it can be challenging sometimes to then say, and even I'll even say it can be humbling to say, okay, I'm going to make this adjustment, and I need other people in order to make this work. Because before it's like, well, I can do it by myself, no problem. Why not? I've read the books and I've listened to the podcast and I've taken the courses, no problem. But on the one thing that's so beautiful, I think, about the multifamily space is you need other people to help you get it done. And so I find comfort in that. But initially it was challenging to adjust. So that was kind of what that was the epiphany that I had, was like, I not only should I seek these people out, but I need these people in order to succeed.
Yeah, I think it's great because, as real estate investors, at least anyone I know who is in multifamily, they're confident. Okay. They believe in themselves. They're intelligent. They know how to do it. And they're self driven, right? So they believe
Mhm.
they can do it, especially if you built your own personal portfolio first. All of those people, me, myself included, right? I built a 13 unit portfolio before kind of going into the syndication space. And it took me a minute to realize this is a team sport. And you hear people say it all
Mhm.
the time, right? It's about relationships, it's a team sport. And I heard it and I understood it, but I didn't really fully grasp the
Yeah.
concept that you are going to have a very difficult time investing in larger commercial real estate deals if you don't have that team around you. And it doesn't just mean the property manager and the contractor and those people, but actual partners, because you're competing against other professional companies. who are buying these
Mm.
properties. They're moving with speed. They've got liquidity. They've got capital. They've got different resources. And if it's just you and you're doing this on the side, after you get off work at 6 or 7 o'clock and eat dinner and you're analyzing deals at 10 o'clock at night and submitting LOIs at 2 in the morning, you're going to have a hard time competing with people who are full-time professionals and have kind of the infrastructure to go after these deals. So treat it like it is a business, because that's exactly what it is. When you buy rentals are, that's kind of a side hustle. You get your house, you find a house, cool. Like, that's a little side hustle. And I'm not knocking it, but I'm saying the mentality is very different, especially if you come from corporate America, because you can buy rentals or a duplex and just run the numbers and put an offer, great. But when you're talking about 50 units and up, at that point, you're really competing with more sophisticated owners, and you really need to have those relationships and those systems and those partners. So, really phenomenal insights that you just shared there. I want to go back, Brandon, to one point you made before about really the velocity of capital, because someone may hear that and say, well, what's the difference, right? If I've got $100,000 to invest, whether I invest this $100,000 in a single family house or I invest $100,000 in this multifamily deal, how does the velocity of my returns change?
So I'll respond sort of with two examples. One is the first two deals that I invested in as a limited partner. They were in the Phoenix market, and the minimum was, I think the minimum for one of them was like around 60K or so, and then the other was just a little bit north of that. And so we get into the deal. It's a kind of a classic, like a C plus type of deal, but in an A minus B plus market. So that imbalance is in our favor. And the team was a really, professional team. So they go in, they add value, and then in less than 3 years, they're getting offers that make sense for themselves. So they do so. And in both instances, they double our capital as limited partners. And so that's sort of an example of how in this space, because sometimes it is hard for people to grasp it. It was hard for me, when people would say it and show projections, and it was a little difficult for me to say, wait, this exists, but it does. And so I can say that firsthand that it does. And another example I'll give you is I attended a virtual summit not too long ago, and one of the operators, they did sort of a recap of some of their exits. Well, not some, it was, I don't know, it was around 12 of their exits, and they have a lot more deals than that. But in that, one of the things that stood out to me was all of their deals had a 5-year projection. 100% of their deals exited in less than 3 years. And I think it was 90% of their deals exited in, boy, I forgot, it's a shorter period of time than that. But the point is, you know, the velocity of your capital can increase greatly using this model, because the turnaround typically tends to be a little bit shorter. So if you get into a residential property, a single family rental, and you're going to hold that in perpetuity, most people don't even consider the exit strategy. They kind of just hold it and hold it. And so it's difficult to measure the velocity of your capital in that way. You can understand your returns, but you won't have your capital back to then redeploy into a new environment. So for me, that's kind of what it means. How quickly can you multiply your position and then redeploy it to do it again? So
Yeah, I think it's a good point, because to your point, I know on the residential side, at least when I was starting out, when I was buying 2 to 4 units, I never thought about the exit. In my mind, we were
mm,
going to buy and hold forever. That was it, right? So it
yeah.
needed a cash flow, and maybe there's a little value add, right? I can push rents $100 or whatever it was. And that was
Mm,
the extent of my analysis starting out, right? And it worked. It
yeah.
worked. It did great. But again, I wasn't factoring the IRR and kind of all those different factors. And when you get into this commercial space, and I had a conversation with the guy yesterday, because when you get into commercial real estate, particularly syndications, now it's real estate still, but it's also finance as well, right? We are
Mhm,
looking at those returns, we're looking at those projections, we're trying to maximize returns, and at velocity, that's really what IRR is measuring, right? Said differently, you can invest in a deal, and over 5 years, it gives you 100% return. But if you get 90% of that return at the end of year one, that's going to be better for you as an investor, because you can
mhm,
redeploy that capital over the next 4 years, versus if you get nothing for 5 years and at the very end you get all that money back, right? So that
mhm,
IRR is kind of measuring that velocity of the return, so you can figure out what you would do to reinvest that capital elsewhere. And that's a metric that's a little sophisticated and it's a little, harder for some folks to grasp starting out, but it does help you to understand why people like to invest in these kind of deals, because you can actually make way more money simply because you can rinse and repeat that capital. It's just like the burst strategy, right? People buy a house, you
Mhm.
renovate it, you rent it out, then you refinance, and then you go and do it again. But once you're able to refinance and pull out that capital, now you have the means to go out there and create more and more value because you still own the asset, it's still cash flowing, but you've pulled out some of your equity. So there's different strategies. I think it comes down to your risk tolerance and what you prefer, but understanding the velocity of your capital, I think is really a game changer for people, particularly if you're in like stocks or other types of investments where it's a little bit harder to implement that strategy. Brandon, talk to us about kind of your approach right now, right? The market's changing. We're seeing
Mhm.
different dynamics. You mentioned being invested in the Sun Belt. You live in DC, used to live in Houston. Tell me about the markets you're paying attention to right now or you're invested in, and what do you see kind of coming up here over the next couple of years?
Yeah, great question. So one of the things that I am paying attention to, very close attention to right now, is value preservation. So when I first started off, I focused pretty heavily on deep value add type deals, and
Hmm.
I still think there's a place for those, but right now my focus is on deals that have almost this inherent value preservation piece to it. And I say that because eh, in the eventual the likely scenario where cap rates expand, I believe that having exposure to, say, a solid, B plus or a Class A type of deal, it dampens that expansion. So you have this thing where your value is therefore preserved in these deals, where it's much easier to preserve values. It's easier to you have a tenant base that really can afford to keep the revenue where it is, or even increase your revenue to the property. One of the things is in terms of strategy that I focus on is deals where you still have like a fixed rate to them, right? So we're looking for deals that have a low assumable loans, right? That's a big one for us. Is there a loan assumption opportunity there so we can have a fixed rate? We're looking in markets that are supply constrained, which is for us is very ideal to be in a place where you have that imbalance between you have supply and demand, but you basically are limited somewhat in terms of new products coming to that market, so you have a little bit less competition. So all those things we're kind of factoring in into how we're looking at deals now. We still say very conservative, much more conservative than say the first half of last year, right? Partially because lenders are requiring that. I think nowadays lenders, even if you're in a market where you're seeing double digit returns, I'm sorry, double digit rent increase, you're going to want to cut that in about half. And some lenders are even going, and being more conservative than that. So looking at deals very conservatively, staying in the key Sunbelt markets, but also looking in areas where we have supply demand in our favor, and then certainly in terms of the structure of the deal itself, focusing on deals where hopefully we have loan assumptions or there's some other opportunity to keep a low leverage, low debt type of scenario.
And Brandon, have you as you've expanded kind of beyond the Phoenix market and being an LP and now being more of an operator, talk to us about kind of how you connect with other investors. I know you've launched a
Mhm.
podcast, so talk to us a little bit more about that as well.
Absolutely. So the podcast, like you mentioned, one thing that I love to do is I love virtual meetups because the world is, and nowadays the world is so small, and we're able to really increase sort of our exposure, meet other people, connect with so many people, which I really have come to enjoy doing. It's funny because years ago, there's no way I would have thought that that I'd be reaching out to so many people to connect. I'm on the phone all day, so I enjoy it. The other thing that for me is big is, when I lived in Houston, there were a lot of meetups that were geared towards syndication. When I got here in DC, there weren't so many. So I started a meetup. And so, which again, I really enjoy it. I love meeting the people here. I love sharing kind of the details and the mechanics of syndication. And it's just become a community. To be honest, I didn't know what it would turn into, but it's really turned into a community where we all support each other, we help each other out, and so those are the key areas where I am sort of meeting with people, and then naturally I have a CRM, so I do the automation piece as well, right? So all those things.
I love it, man. I love it. Well, listen, what's the name of your podcast and how can listeners find it?
So it is the Capital Stack podcast, and we're on Apple, Spotify, Google Podcasts, and just all the major platforms. And yep, you find it there.
There you go. And Brandon, if people want to find out more about you and investing with you and just more about your firm, what's the best way for them to get in touch?
Sure. So the website is Birch Prosper. That's BIRCHPROSPER.com. And you can email me at brandon.jenkins, BRANDON.JENKINS at birchprosper.com. I would love to hear from you, and we can set up a call.
I love it, man. Well, listen, check out Brandon there. We'll make sure to put links to that in our show notes. Right now, we're going to move on to our round of insights. All right, Brandon, give me a failure or an apparent failure that sets you up for later success.
So I'm going to try and be brief, but I will tell you that a long time ago when I was in undergrad, I saved up $2,500 and I went to Bank of America to open up a CD. So at that time, CDs had very, very attractive rates and a low term. And so I went there, sat down, ready to give to get it into the CD. And then they went and said, "Hey, listen, I'll bring the paperwork. Just give me a second." And then between the time that they left to get the paperwork and were on their way back, I ran out the door. And it was really just because of fear. It was because of inaction. Even though I had done some homework to say, okay, this is what I want to do, that fear just overtook me. And so it's turned around to something that I now use as a springboard, I guess, for success, because I know now that having fear, especially unnecessary fear, can lead to inaction, which can lead to missed opportunities. So I no longer am someone who will have all the data and have all the information, but won't take action. I take action fairly quickly on things that I believe in.
I appreciate you sharing that. All right, give us a digital or mobile resource you recommend for your business.
So I use something called Xmind. So it's a mind mapping software, and I use it for everything. I use it to build out my monthly and quarterly goals for my 2-year plan. I even used it for to create an online course. So it's something that for me is absolutely instrumental. If you ever have done mind mapping or familiar with it, it's a great organizational tool. So that's one that I'd recommend.
All right, give me the book you've recommended or gifted the most in the last year.
It's definitely Who, Not How by Dan Sullivan. Just a great book in terms, just helps you understand how to leverage other people's passion, other people's energy to help sort of grow mutually and achieve your goals and their goals as well.
What's a daily habit that helps you stay focused on your goals?
So my routine, I'm gonna say, so for me, the first thing is making my bed in the morning. That one is the one that for me is the biggest. It's an easy win in the morning. It's the first thing you wake up, you feel good, you feel fresh, lets you know that each day you can start anew. So that's one. Morning prayer, I do that every morning. And then affirmations, and also listen to like a very short motivational clip just to kind of help me stay plugged in. And help my mind stay sharp and focused on what I have to get accomplished for the day.
What's your number one insight for multifamily investing?
I would say to never stop learning, never stop growing, and to fill your calendar. Okay, that's one that one great way to do it, I think, is to actively seek out like mentorship and coaching groups, that are full of high performers that are where you want to be. So I would say those things are definitely big.
I love it, Brandon. All right, well, listen, let's lighten the mood a little bit. You are in the DC area and lots of great restaurants there. What's your favorite place, or where's your favorite place to grab a bite to eat?
Ooh, that's a tough one. So we like, there's a shop that I actually like called Chop Smith. It's not really one of the more, it's I would say a little known restaurant here, depending on where you are. But if you're near the waterfront, then that's a really good place. You can get a good, they have a nice crab cake sandwich there that's pretty good. So I recommend there, but anywhere near the waterfront, I don't think you can go wrong.
I love it. Well, listen, Brandon, you gave us a lot of great insights. I appreciate you sharing kind of your journey from the oil and gas industry as a petroleum engineer, getting into some rentals, doing some flip projects, ultimately getting into multifamily, first as an LP, and then making that transition to the GP side of things, and also how you're revising your strategy a little bit to prepare yourself and navigate the current market landscape. Again, if anybody wants to learn more, you can check out the Capital Stack podcast, and you can check out Brandon, send him an email. Brandon, what was that email address one more time?
That's brandon.jenkins@birchprosper.com.
And again, we'll link to all of that in our show notes. Brandon, I want to thank you again for coming on the show, being an amazing guest. We look forward to staying in touch, and I hope you have a great day.
Awesome. You as well. Thanks, John.